what's going on with the economy and potentially what's coming. And then we're going to look at some technical analysis to look at the various financial markets that, people are most interested: the dollar, S&P, gold stocks, and treasury yields.
You're listening to Kerry Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
And welcome. You are listening to and watching the Financial Survival Network. I'm your host, Kerry Lutz, and we're here with our good friend, Jim Welsh from macrotides.com. And Jim's got some info that he wants to share with you. If you've got any questions or comments, you can always send an email to me, kl@kerrylutz.com. In the meantime, Jim, you find him at macrotides.com. Jim, great to have you back on. So, hey, you got some new numbers for us.
Great to be joining you, Kerry. As your viewers will see, we're going to look at the fundamental side of the equation in terms of what's going on with the economy and potentially what's coming. And then we're going to look at some technical analysis to look at the various financial markets that, people are most interested: the dollar, S&P, gold stocks, and treasury yields. So, as people may remember, the Bureau of Economic Analysis, when they did their first revision of first quarter GDP, it dropped from 1.6% to 1.3%. And as I discussed in various letters, that was a little misleading, Kerry, because the BEA subtracts imports. And the reason why is because they're trying to capture domestic production. So the point, though, is if demand is so strong that it's being fulfilled from overseas, that doesn't reflect weakness. So they subtracted 0.9% from first quarter GDP. And the second thing is retailers paired inventories, which subtracted another 0.5. Now, what happens is when they cut back on inventories, unless the economy slows immediately, over time they're going to rebuild those inventories. So the point being is that 1.3% was really closer to 2.7 when you adjust for these other factors. So the idea being is, do we need to be worried about a recession right here, right now? No, but I think what we're going to review is some indicators that suggest a market slowing in the economy is coming. And I like this quote from Somerset Vaughn. The fact that a great many people believe something is no guarantee of its truth. And look at the chart below, which it shows that now 88% of economists, as surveyed in the first week of June by Bloomberg, don't think we have to worry about a recession. And the counterpoint is back in 2022, the majority of economists thought we were going to be in a recession, and if not in 2022, 2023. And in 2022 and 23, my point was job growth is really strong. Consumers still have money. So the idea that we were going to have a recession in 2022 or 2023 was unlikely. At this point, though, just at a time when everyone else is like, hey, we don't have to worry about a recession, I think there are reasons why more caution is warranted. And so if we skip down to the next page, consumer spending has really been the linchpin under the economy. And the bank credit analyst has a model where they look at the individual state unemployment numbers. They adjust them for the population in each state and come up with an adjusted unemployment rate. And historically, going back to the late 1970s, Kerry, anytime this has gone up by, I think, 25 basis points, it signals a recession. There has never been a false positive. In other words, there's never been a time when it's, oh, yeah, we got to worry about a recession, and then one didn't show up. So in March, this gave a recession signal. And historically, going back to the late 70s, the lead time has been less than 6 months. So to me, again, I'm going to take from this, not necessarily, oh my God, the sky's going to be falling here 6 months from March, but that the notion that the labor market is going to remain strong, this really casts doubt on whether that's going to be sustained. And the next chart kind of shows, and it hasn't been getting a lot of attention, is the unemployment rate bottomed at 3.4% in April of 2023. So it's been kind of creeping higher. You know, it's like putting the frog in the pot on the stove, and the temperature gets increased very gradually. Well, the unemployment rate's gone from 3.4 to 4% in May. Historically, going back to 1945, Kerry, whenever you've had this amount of increase, there has always been a recession. And again, I'll say there's been a lot of unusual aspects to this recovery. You know, one being the huge amount of government spending, which is continuing. The deficit for this year just got revised from, I think, 1.5 trillion from in February to 1.9 trillion. So again, what we're seeing is, hey, the consumer has been the linchpin, and the labor market has been very beneficial. I think it's going to slow. This looks at yield curve inversions going back to like 1928. And what it shows is whenever there's been an inversion over 350 days, a recession has surely followed. We're at about 603 days, I think, as of yesterday or late last week. So again, my point is, I'm not saying, the sky's falling. It just raises the probability, in my view, that we're going to see a market slowing in the economy as all these things kind of come home to bear. And, the Fed has decided higher for longer, which didn't surprise me one bit. But the reality is, for small businesses that use the banking system for funding, that higher for longer is significant because they're paying 9 to 11%, most small businesses, to borrow money. And small businesses in this country create 50% of all new jobs. So the longer we go with these rates where they're at, Kerry, it's going to, I think, weigh on small businesses. And again, that has implications for the labor market.
All right. Yeah. So the number of days that this inverted yield curve has persisted for, and really the Fed's been powerless to do anything about it, really is sending out major alarm bells, isn't it?
Yeah. I mean, that, to me, the takeaway value here on these stats is, again, the economy is going to be slowing, I think, markedly as we go towards the end of this year and especially next year, because I think commercial real estate is going to be a more significant problem next year. Last year, banks did extend and pretend. In other words, loans came due and they worked out some stuff, pushing it off in the future. But as we all know, the home or the office market isn't improving. There's a glut of apartments out there. So we're seeing price declines in multifamily apartments. So again, this is a problem that's kind of in the back burner, out of sight, out of mind. But I think as we get into next year, it will become more important. And obviously, if the economy slows, it's only going to worsen that situation. Investors have been focusing, when is the Fed going to cut? When's the Fed going to cut? So I went back, and if you go to scroll down just a little bit, and I went back to when a recession started, and then where was the S&P when the Fed made the first rate cut, and then what subsequently happened. And what it shows is going back to 1969. In each of these instances, other than 1998, there were kind of some special circumstances that were going on in 1998. But what you can see is more than 80% of the decline, and the average decline was about 38% in these bear markets. 80% of the decline in the S&P happened after the first rate cut. So the reason is the Fed historically has not cut rates just because inflation came down. Mm-hmm. They cut rates because the economy slowed, the unemployment rate started ticking up, and they cut rates in order to, if you will,
play catch up
and soften the slowdown in the economy. And of course, that has implications for earnings. And right now, Wall Street expects earnings to be up this year and next. The PE ratio is elevated relative to the average over time. And so historically, that's why you get these big declines in the market when it realizes, oh my goodness, the economy's slowing, we're going into a recession. Again, from a statistical standpoint, we're seeing indications the economy is going to slow, and at some point in time, the Fed's going to respond to it. But if the economy subsequently goes into a recession, it historically has been really bad news for the stock market.
Okay. All right. So you're full of
joy,
bright, bubbly news here.
No, you know what it is? Kerry, is I want to keep my head on a swivel. And so whenever there's a narrative out there that's widely embraced, I always want to kind of say, all right, is it justified? And always for a period of time, whatever the narrative, it is justified. But at some point in time, the narrative runs its course. And the way to avoid getting hurt in the stock market or other financial markets is to kind of see it coming. So technically, I'll use this analogy. We drive 6 or 8 cylinder engines, cars, and if all the cylinders are working together, we got great pickup when we step on the gas. Fuel economy is pretty good. Everything's copacetic. But when one of the cylinders or 2 of the cylinders start being out of sync with the others, well, acceleration isn't so good.
Yeah,
fuel economy goes down, and ultimately the engine breaks down. So the point in the stock market is, in a healthy market, the averages are either going all up together or going all down together. It's kind of like, okay, everything is in gear.
Right.
At inflection points, things start to diverge. And when you're at a market high, yes.
Yeah. Yeah.
Okay.
Agreed.
So when you're at a market high,
Yeah.
what happens is, hey, what we're seeing is, look at the semiconductors and what they've done from May 15th until June 18th. And what we can see is up 19%. In the meantime, the broad market, the New York Composite, 1,700 stocks, that's down. Value Line Composite, 1,700 stocks, that's down. So we're seeing a huge bifurcation. So everyone talking about the economy's really okay, but the behavior of some of the broad market averages, Kerry, suggests that there's more concern under the surface. And this kind of discrepancy is normally what we have seen historically at important market tops. Everyone's excited about NVIDIA. I get it. Artificial intelligence is, going to change the way we live.
It is already.
Yeah,
I mean, I didn't tell you this, but I made a bot that looks just like you, Jim, so I don't need to interview you anymore. This is going to be our last interview here, just so you know.
That's quite right. I'm sure that bot will be even smarter.
You just let it know what
I'd be saying much, right?
just tell it what to say, and it'll take care of everything.
It'll just go from there,
And you can just,
I can put my feet up and hit a train. Yeah, great. Well, what I wanted to point out is semiconductor stocks are obviously critical and at the forefront of artificial intelligence. People can't buy enough of them, type of thing. But semiconductors are hugely cyclical. So if we scroll down just a little bit, there's a table showing how the semiconductor, one more down. There you go. So what you can see, coming off the dot-com bubble. I mean, the internet was amazing, right? I mean, talk about how badly the economy would have been during the pandemic if we didn't have the technology that existed, to do Zoom meetings, to be able to do ordering online and all the rest of it. All right.
Very true.
The internet certainly fulfilled whatever the hopes and dreams were back in 2000. But as the economy slowed, companies were forced to cut costs and they stopped spending as much money. So you had stocks that had a very high PE ratio because they were growing at 30% or more. And all of a sudden that growth decelerated rapidly. So in the 2001 recession, which was a very mild recession, I think GDP was down like 1.4%.
Yeah.
The semis were down 83%. 2008, deeper economic contraction, semis down 65%. So my point is, this enthusiasm for AI and the semiconductor stocks, I understand it. But at the same time, I think some of the people that are barreling in this believe that it will be immune to the business cycle. I'm sorry. If you get a recession, no company is completely immune to the business cycle. So my bet is that if as we slow down between now and year end, I think a recession becomes a higher probability next year. I think the order rate for computer chips is going to slow initially and then drop. The other thing I'll point out is in the last 12 months or so, I think companies have bought $50 billion worth of chips from NVIDIA.
Yeah.
But those chips by those companies only generated about $3 billion in revenue. So I think there's this window of time where all this enthusiasm, but then there's going to be a valley as people struggle to monetize what they spent, that it's going to take time to convert artificial intelligence to meaningful, real-world, positive outcomes. And during that window of time, if I'm right, what's going to happen to the order book for NVIDIA and the other semiconductor stocks?
Skid, right?
It's going to skid. Absolutely. So that to me is the warning. Let's go down a little bit further. One thing, I don't remember if I put that in here or not. Maybe I did. We'll see. Okay, before we leave to the semiconductor issue, NVIDIA had a key reversal on June 20th. So did the semiconductor index. The last time that happened was March 8th, and it ushered in a correction that ultimately NVIDIA dropped 22% by mid-April, and the semis, I think, were down maybe 11 or 12%. So that key reversal we saw a couple of days ago, I think, is kind of a clarion call that, all right, we're going to see these stocks undergo a correction.
Right.
Lagged performance in the Russell and the value line in the broad market, I don't think we're going to be able to see a rotation that cleanly the baton gets passed. So I think everything is set up. I was looking in late March for a 5 to 7% correction. The S&P dropped 5.7%. I think we're close to something similar, Kerry, over the next handful of weeks. So
Okay. So if I go back to the ancient era of Alan Greenspan, you would call this irrational exuberance, and it looks like it's coming to an end.
Yeah, I think so. I mean, again, at least in the short term, and then we'll see how the market corrects, the pattern that develops to be able to discern, all right, is this just another correction like the one in April? And we're going to have another rally to higher highs, or is it going to be more menacing? I can't know that right now. All I know is the warning signs in terms of the divergences with the marking averages and the advanced decline line hasn't confirmed this new high. Same thing happened in January of 2022, October 2007, and there's many other instances going back. So the table is set. It really all comes down to, Kerry, does a reason to sell materialize?
Mm-hmm.
Whatever it may be, because the weakness of the market internally tells us that it'll struggle to deal with an increase in selling pressure. And that's the setup. Now it's just a question of how important the reason to sell is.
Yeah.
So we can look at gold and some of the markets.
And we could have liquidity issues that force liquidation in the stock market. We know when there's a liquidity matter, a liquidity event, that the first thing people dump are stocks, right?
Well, especially the highly liquid stocks,
Yeah.
and
More liquid, the better.
Yeah, and eventually you get down to the overowned stocks, and when they go down enough, it's like, get me out. All right. So in terms of gold, the bigger picture is from the low at 1812. I think gold has had 3 waves up, and we're in the middle of a wave 4 correction. We had a fake out where gold hopped above for one day that upper declining red trend line, reversed down on Friday, and I think the odds are gold's going to trade below the 2282 and we could see it as low as like 2205 based on retracement levels and so forth. But once this correction is over, Kerry, I think we're going to see gold rally to a new all-time high, above 2,500 and potentially, higher than that, and take it one step at a time. So
how long you think that's going to be, Jim?
My guess is gold will bottom in the next 60 days. It could be 30 days. That this correction, we're nearing the end of the correction. I just think there's like one final flush here as gold takes out that prior low. It's going to hit stops and so forth. But my point is, rather than being intimidated by it, it's an opportunity, in my view, to be a buyer. The gold stocks, very similar in the sense that if I'm right about gold pulling back, the gold stocks as measured by GDX, the ETF, I think will have a period of weakness. And then, as you can see up there, I'm giving some instructions in terms of buying IAU, which is the gold ETF, because I'm going to be a buyer on the upcoming weakness and scale in a little bit based on if gold drops below 2282, does it get down to 2240? Okay, you want to buy some more.
I like that chart. I do like it. Kind of cup and handle. We saw the cup and handle in gold and in silver. So, now it's going to retrace a bit, right? Kind of trendless. It had a huge move. Yeah, it had a big move. Chart.
And people got really bullish. A month or two ago.
But double topped also. So.
Yeah, and that, from a technician, you say, oh, okay, that looks ominous and so forth. So again, just from a price pattern standpoint, I think it's
a good looking chart.
It's correcting for a wave 4 and wave 5. If it bottoms at 2250, 2550 or higher, becomes.
You can see it.
Yeah. And the gold stocks, have really been lagging for a long time.
Oh, God, yeah.
And I think there's a catch-up trade coming there. And if we go down to a little bit further, Kerry, and of course, this is going to be, I think, on your website, so people can read all this stuff from there.
We'll have a link in the show notes so you can download Jim's report and, follow along on the podcast. Yeah.
So anyway, I think GDX can drop to the low between 32 and 32 and a half. 31 and a half is possible based on a retracement of the big move from 25 to 37. I think I can't remember what the retracement was whether it was 50%. That sounds about right, maybe. $12, $6. Yeah, it'd be 50% retracement. But again, I think this weakness is a buying opportunity, and ultimately, I think the next rally will take out the $37 high that we saw 4 or 6 weeks ago. And there was a high going back a little bit further near 41. So I think GDX is setting up a nice entry point for a rally that ultimately I think will take it up towards 40 to 41. So that'd be a pretty nice trade. So
I wish you had Newmont's chart in there, because Newmont's due to report some monster earnings because the price of gold has gone up over $250, even if it's partly hedged, since their last earnings report, where it was like around 1900 something. And their earnings are going up, and the stock is doing absolutely nothing here, Jim.
Yeah. I think one thing that's happened, Kerry, is money that maybe in the past would have traded the metals as well as the metal stocks is trading Bitcoin. In other words, people are looking for action. Okay, in the past, hey, you want a beta? Go buy a gold stock or buy silver.
Yeah.
Okay, TLT. I turned positive on TLT over the last couple months. On average, we're long at around $91 of TLT. Again, my supposition is the economy is going to slow more than expected. That TLT declined from 179 in March of 2020 to 240 in October of last year. So again, a 382 retracement, I get you up to about 119. So the initial rally went from 82 to 100. That's $18. You had $18 to 87. You're at 105. So I think TLT is going higher, but at a minimum, it should, in terms of from the low in October of 23, you had an A wave up to 100, a B wave down to 100, or pardon me, 87 and change. I think we're at the beginning of a C wave that will take TLT above the prior high at 100.57 and potentially up to 105, 109. And if the economy really goes into a recession, that 119 number is a possibility. So, wow. Yeah, I mean, just again,
makes
longer term. Yeah, longer term, I'm bearish bonds. And the reason being is when it went from 79 to 82, and I've got reports if anybody wants to see all this good stuff, it declined in 5 waves. For me, that means the major trend in bond prices is down and yields are up. But after a 5-wave move, you're always going to get a retracement move. And that's where we're in the middle of that retracement move.
Got it.
If we get a recession, the deficit is going to go from 1.9 trillion to probably 3 trillion. So the amount of supply the bond market is going to have to handle in the next recession and beyond, I think it could be overwhelming. Yeah, exactly. Yeah, and that's why yields can go up.
Yeah, can you spell monetize?
Good luck.
All right. So we got time for one more. We got time
dollar
for the
index,
dollar.
Real quick. That red trend line is just the 10. It's I think a 106.25. We're flirting with that. So I've been looking for the dollar to top and roll over. But what's going on in Europe with the French elections has caused the euro to be quite weak. It's 57% of the dollar index. The elections are going to be held June 30th and July 7th. So to me, if the dollar closes above that red trend line, again, that would not be good for gold, I don't think. It's not good for the U.S. economy. So to me, the dollar is at kind of a critical level here of around 105.75.
All right.
There's one more thing on the S&P. If we can I'll do it real quick.
Okay, sure.
So all I'm looking for, based on all the stuff we talked earlier, I think the S&P is set up for a 5 to 7% correction. There's some price targets mentioned here. I think there's a shot, Kerry, that you could see one more rally above 55.05 to complete the move up from last April's low. And I think that would be a place to go short.
All right. Excellent here. Really good info here. I've known you long enough to know that, you're right a lot more often than you're wrong. And I think it's a reasonable analysis. One thing we didn't talk about, don't really want to, of course, is the election and what's happening there, because that all figures into this, but maybe in ways we're not totally clear about right now. Hey, make sure you go over to Jim's site. The link's in the show notes to this interview on financialsurvivalnetwork.com. When you're there, sign up for your free newsletter, and it's macrotides.com. Questions, comments, etc. KL@kerrylutz.com. Jim, appreciate you sharing this with us. Again, the link is in the show notes to this interview to download Jim's report, the PDF, and Jim provides that to you gratis. And you might want to take a closer look at macrotides. Jim, appreciate it all. And let me stop the share, and we will
everybody. You get a good look at 2 good-looking older gentlemen.
Yeah, well, that's it. Especially that, right?
Yeah, the gentleman, right? Not the older part.
Yeah, well, let's not talk about that.
Yes.
We're talking about happy things like the economy and the market going down. I don't want to talk about my physical presence.
They used to call that piling on in football,
Yeah.
15-yard
mile on. I'm good. All right, Jim. Hey, talk to you in a month or two. Be well.
Sounds good. You too.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network, now more than ever.